Well, hello guys. It's Danny Deals here. Thank you for tuning in to Un Poco Mas, the show where we give you just a little bit more. About a week ago, I made a video trashing the Carvana stock and how I thought it was a big giant turd that should have gone bankrupt already, and how they're basically insolvent and can't service their debt and are making negative cash flows and just made a lot of bad decisions. With regard to how they handled their growth, why they didn't capitalize on that growth when everything was aligned in their favor. And now it kind of shows you, they say everyone's a genius in a bull market because everyone's making money, all the boats, the rising tide is lifting all the boats. And when adversity hits, that's when you sort of see what a company is made of, what the management is made of, and what their business model is made of. So basically, you know, I feel like Carvana is a good name. They have a lot of goodwill associated with their name, and I know that they have some innovative, sales techniques, and they have some sort of AI stuff they're working on in terms of used car sales. But there's just a couple of reasons I don't think this stock is going to make a comeback. I know there's a huge short on it, and I know there could be a short squeeze. There sort of have been a couple of small short squeezes here, as there's been a bit of covering of late. But today with Carvana, it's sitting at $11.92, up almost a dollar. Volume is only 9 million shares. If I zoom out very quickly, just want to look at the live short interest. The borrowed change today, loading, is minus 700,000 shares. So 600,000 shares borrowed, 1.3 million returned, and the daily short interest has gone down a bit. Estimated short of free float is 62%, and free float on loan is 64%. Cost to borrow is down considerably. Utilization is still listed as 100%, but obviously there are some shares available. So if we take a look at the issues with Carvana, I believe they are numerous, but one of the things I think is just problematic, inherent to the business model and inherent to the selling of used cars, is that getting massive scale as a used car dealer essentially does not help you in the same way it might help a traditional retailer. Um, Economies of scale aren't going to lead to big cost reductions. This isn't like a Walmart or a Costco or a Home Depot where you're buying millions and millions of widgets from one supplier. And you can say, listen, if we're going to buy a million of these things from you, instead of you selling 10,000 to, 100 different small stores, you sell us a million at a time, and you can take your margin way, way down because you don't have all the cost of selling those and stuff. We're going to essentially take everything you can produce, but then you're not going to make any money. So it's like, Carvana, that doesn't really work because the supply of used cars, it's not like if they sell way more cars, they're going to be able to get cars substantially cheaper. At least not currently. That's not how the wholesale market in used cars works. And if you do get a lot of cars, you might get caught with your pants down. And, they have over $1 billion in inventory, and the value of that is going down every day. So that's just ripping another hole in their balance sheet, which is already terrible. Like, this company is barely staying in business. They're trying to do a cram down on their debt because they're basically insolvent. And I mean, if you look at their cash, they have like less than 500 million at the end of Q1 2023, and then on liabilities, you're talking about long-term debt of 7 billion, and they also have some short-term debt. it's like even if they can get their creditors to take a cram down and extend the duration of their loans and give them more favorable terms. I mean, even if they could somehow push their debt down to 5 or 6 billion dollars, they're also making negative cash flows. I mean, and they just made big improvements in their costs and stuff, but their operating cash flows um, are still really bad, and they still lost 100 million um, free cash flow in the quarter we just ended here in March, Q1 2023. I'm not sure what their accounting year is, but what I'm calling the first quarter of 2023. And then last year, they lost 800 million in free cash flow. So I'm just trying to see like what is the silver lining of this business, and they're talking about, okay, they're using AI and machine learning. Again, this is used cars, guys. I mean, it's very price sensitive. Like during COVID, people were willing to pay cars were very scarce. People were willing to pay to have them delivered to the house. Like this is a business, and people are like, okay, Carvana's in a great position because a lot of the used car dealers are going to die, but that doesn't mean someone else can't step in who actually does a better job and has better, more seasoned management and put used cars online. Like the unique selling point of those big glass things is not really a unique selling point because I don't think most people care about that. They just want the best car they can get for the best price they can get it for. And that's why economies of scale don't really benefit you that much in the used car game. It's thin margins, and there's competition to acquire the cars at the best prices. Acquiring more, I mean, yeah, they could probably buy like a lot of cars from one of the rental car companies, but they sell their own cars and they already have scale and they already have sales channels. So it's like there's only so many bites at the apple and so many people in the line who can make a profit. And bottom line, Carvana does not have any special, magical sources to acquire quality used cars. And you say, okay, well, they have other people using their marketplace to sell their own used car, but how much money are they going to make on each one of those transactions? I mean, I guess it's like a fee, perhaps a percentage based fee. I'm not sure how that works, but if you look at their books, it's not working. I mean, they lose money on every single car they sell, and people are like, "Well, but it's a short squeeze. It's a short squeeze." I'm like, "Yes, you're right. You can make money swinging this thing. I mean, obviously, it just went up a whole hell of a lot. Um, I don't know. The stock was just, it's $7, and now it's at $12. So if you traded that, and now it looks like it might gap up again. Um, let's take a look at the Carvana chart here. A key level on this guy is $13.15. Like the stock just touched that 3 times on 5.9, 5.10, and 5.11, was rejected, dipped back down, touched it again on 5.23, and looks poised to make another run. That was a key pivot point here again in February. I realized the stock went all the way up on one day to 17.50, but if you look at that 13.15 level, it held right on that at February 7th. It was a little bit of support February 6th, support February 3rd, support on February 2nd, and basically was almost the low of the day on February 8th. So that is a key pivot point all the way back. And then even if you go back to last October 2022, $13.15 provided support there, and then was again, looked like it was going to be support here, and then some news, the stock essentially fell way off. Dropped like 30% of its value in one day, came back up, and so I just believe that is a really key level there at the $13 and 15 cent level. You see that depicted here, turds, and I wrote the word turd here with my mouse. It's not really relevant, but there it is. So we have to see, can this stock break through 13.15, and then we'll see, can it actually make a run? Can it actually get a short squeeze going? But I feel like market makers, shorts, turds, ne'er-do-wells, scoundrels, scalpers, and corner office, short-long hedge fund D-bags are going to try everything they can to keep the stock under $13.15. Let's take a look at the options on Carvana here. Where, oh, where is that call volume. Not an extreme amount of volume. Most of the weight sitting at 1150, 12. A few brave souls at 13, and I can see why. Again, that 13, 15 was an area to test. Puts, got a few puts hanging around. They're putting out a vibe at 1050, 11, 1150. Puts are running about half the call volume, or maybe 40% of the call volume. So that's bullish, but let's face it, retail turds always buy calls. They don't buy a lot of puts, and they don't sell options unless they're selling covered calls. So they tend to feed premium to market makers and not let time decay work for them. It works against them. And they sell this, they buy this short term options and often lose their money. But in any case, guys, Carvana today taking a little bit of a downturn here in the last few seconds. Probably a little bit of a short attack, but still up 85 cents or 7.77% on the day. Um, I just think, guys, the debt is too hard. The debt is too large. Cram down of their creditors is an admission they are insolvent and can't service their debt. Company is making negative free cash flows, and I think will be for the foreseeable future. It has huge exposure to these interest rates, which aren't going to fall rapidly. Horrible time to try to refinance their debt. It's hard to get money. Um, the value of all their inventory is shrinking daily, and they're going to have to sell what they hold at a loss. Look, everybody thinks, okay, it's great to scale, and we're going to use machine learning and artificial intelligence to scale. Well, I just want to point you to like Zillow and their like home buying deal, where they were going to buy all the houses and they were going to control the market and they were going to fix up the houses and sell them at these huge gains. I realize housing and car market is not the same thing, but there's an arrogance to think like you're going to reinvent the wheel and you're going to do everything better and you're going to use, machine learning and AI to, make things more efficient and just make money out of thin air. This is kind of like the Kathy Wood thing where she's like, you're like, hey, all these businesses you're telling people to buy are losing a whole ton of money and they're going to be for, the foreseeable 5, 6, 7 years. And she's like, but, she's like, but they're disruptive and we invest in disruptive, and it's like, yeah, but the disruptive company is not necessarily the one that gets to the finish line. Some company might have an idea and disrupt something, but their management is not agile or smart enough, and they end up like not being the company that actually capitalizes on it because they can't make any money, and some other company comes along and does that model way better, and another company. So the first disruptive company often doesn't make it. It's the company that sort of lifts their idea, perfects it, brings in the right management, brings in the right people to crush the competition. And frankly, I think Carvana has shown that's just not them. Their management spent like drunken sailors. Um, I saw which is a great thing, but I saw this thing Carvana donated like to some pickleball foundation for disabled people. And that's wonderful. I mean, I'm not against disabled pickleball players or anything like that. But it's like, are you serious right now? Like, you should be going bankrupt. You're not, trying to get these good headlines is one thing, but let's keep our eye on the prize here. They should be cutting costs dramatically, which I know they are trying to do, but bottom line, these founders had a great, vision that caught fire, but they just did not have the discipline to capitalize on their growth by making a profit for their shareholders. This company has never made $1, and I don't believe it's about to. So short squeeze it may. Swing traders just made a bunch of money and may make a lot more. Shorts may get slaughtered. They may reshort hard. But in any case, this thing is going to be volatile and it's going to be fun to watch. And one side or the other or both are going to make money depending on what day it is and which way the wind is blowing. But I think at the end of the day, this company just has too much debt. They are not making any money. They're not going to make any money. And management is just going to look to keep getting paid and drag this thing out. But obviously, creditors don't like bankruptcy. Management doesn't like bankruptcy. A lot of people get wiped out. Of course, shareholders don't like bankruptcy. And this company is probably not going to go bankrupt because they're probably going to be able to cobble together some kind of a deal with their creditors. But often who's getting fleeced is the new people coming in. Like, at the end of the day, probably in a few years, this company's either going to get sold off for pennies on the dollar, or it's going to go out of business because it's insolvent. It doesn't make any money. It's losing 100 million in free cash flow. It's got about $8 billion in debt, and less than half a billion in cash. So you do the math, and if that sounds like something you want to buy, God bless you. I'm not giving you financial advice. You pour that money into Carvana, you get that short squeeze, and you get your money. This is Danny Deals. Thank you for tuning in to Un Poco Mas. The stock is Carvana, ticker symbol CVNA. It is Friday, May 26, 2023 at 10:23 a.m. out here on the Pacific Coast. That's about 1:30 out in NYC. Hope it's a great day wherever you are. You guys have a great weekend. I will be talking to you again real soon.